Good morning, everyone, and thank you for joining us for a Moss Adams webcast. We were going to start in just a minute here. We're having a slight technical difficulty, so please hold on. We will start in just a minute. For those of you just joining us, we are going to start in 2 minutes here. We're having a slight technical difficulty, so please hold tight. Thank you.
Welcome, and thanks for joining us. Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the File folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances. We're now ready to begin.
Well, good morning, everyone, and thank you for joining us. My apologies for the late start. We are all set to start preparing for your first 401k plan audit webinar. If you do have any questions about CPE or any technical questions, please feel free to reach out to me. My name is Courtney Irvin, and I'm the webcast producer for today's presentation. So we'll go ahead and get started. I'd like to introduce our moderator today. Her name is Bertha Minahan. She is our National Practice Leader for Employee Benefit Plan Audits. Bertha has been in public accounting since 1995. She has extensive experience directing all phases of audits for a variety of benefit plans, including 401k, 403b, pension, employee stock ownership, and health and welfare benefit plans. She has also worked with a number of 11k clients. Her ERISA experience includes the specialized knowledge required for audits, Form 5500s, and related filings. Bertha currently serves on the AICPA's Employee Benefit Plans Experts Panel and has previously served on the AICPA Employee Benefit Plan Audit Quality Center's Executive Committee, chaired the annual National Benefit Plan Conference, and also has served on the AICPA's Technical Standards Subcommittee. And with that, I'm going to go ahead and hand the presentation over to Bertha.
Thank you, Courtney. Welcome, everyone. I'm going to introduce Ryan, our speaker for today. It's my pleasure to introduce my partner. He's been in public accounting since 2001 and primarily serves employee benefit plans and venture funds. He specializes in all aspects of employee benefit plan audits, including traditional 401k, defined contribution, pension plan, health and welfare, and some SEC and 11k filings. So you're in for a treat, and he always does a great job for us on this webinar. Ryan?
Thanks, Bertha. Hopefully everybody can hear me okay. I'm sure if we can't, Courtney will let me know as soon as people start sending in questions or comments that they can't hear anything. One thing I will say is before we even get started that we're going to be talking about a lot of different things. The focus obviously is going to be on going through your first 401k plan audit or just kind of refreshing yourself on what a 401k plan audit is, but it's going to be kind of from the perspective of a new company, a company that just kind of grew up, so to speak, crossed the threshold, needs to get their first 401k plan audit, and what to expect from what we all do, the auditors, and what we're going to be looking for. So that's kind of the requirement. So the learning objectives kind of circle around that. What are the requirements for first-time audits? What you can expect? What is fiduciary responsibility and what a fiduciary should do? And then also common trouble areas around operational compliance. We're also going to be talking about financial reporting a little bit, although that's not going to be the main focus of what we're talking about. One thing I will say before we get too started is if you have questions, if you have comments or anything like that, feel free. We'll have a quick Q&A session at the end, but it's good to kind of address those questions as they come up during the presentation to keep on topic. So please submit your Q&A via the Q&A button on your presentation, and we will answer them as we go. So first thing, we've got the polling questions. Make sure you answer these to get CPE credit. So where are you focusing your day-to-day operations? We've got HR, finance, plan admin committee, or a combo, mixture of the above, or you're just here kind of checking it out. You have nothing to do with it. You're in something else.
You've heard we're awesome, so you're here.
Yeah. So I'll give it another 5 seconds or so to kind of submit and make sure everybody doesn't miss the first question.
This helps us get a hold on the audience.
Absolutely.
We're going to talk about a lot of different things, so it kind of helps us to make sure we cover something for everyone.
Right. Okay. So we're going to go ahead and run the poll results. Most of you all are in finance. That's not too surprising because we saw the attendee list before we started.
We did.
But also 17% in human resources. What I will say is that we'll talk about kind of the finance side of everything, what the CFO controller side will be concerned about when it comes to a 401k audit. But generally, we work a lot with human resources, so it's going to be good for both sides.
I think also it's good for finance folks to know what human resources are doing in relation to the audit, because I think sometimes it's not clear who's providing what, and finance folks just think of an audit as an audit.
Correct.
So it's good to kind of see the other side and see what your folks are really busy helping us, kind of work through. Absolutely.
I mean, when you look at the financial statements from a controller CFO perspective for a benefit plan, they don't look like there's a lot in there. But if you as we kind of go through this presentation, you'll see that there's a lot that we're focusing in on that has nothing to do with financial statements. So we're gonna get moving here. So let's talk about the requirements. The first thing is people get a little bit confused about when and what needs to be audited when it comes to benefit plans. So 401k plans are required to be by law to be audited by an independent accounting firm. This is based on the size of the plan on the first day of the plan year. It's based on 100 eligible participants. 120 if you've never been audited before. So you have a little bit of wiggle room. It's not you probably hear the 100 eligible participants a lot, but at 120, if you've never been audited before, you get a little bit of kind of leeway of 20 people. So and the other requirement is that assets have to be held in a trust. All 401ks are required to have assets held in a trust. So if you have a 401k plan over 120 eligible participants, you're going to have to get an audit. Let's talk a little bit about what an eligible participant is, because there's some misconception around that concept as well. That's all eligible active employees. That's not people that are just participating in the plan. That's any employee who could participate in the plan. So if you have no waiting period and everybody's immediately eligible to participate in the plan, that's every single employee that you have. Plus, there's actually more people. Anybody who's a terminated employee that has participated in the plan previously and not taken their account out of the plan. So if you've got a bunch of old employees hanging out in your plan that don't work for the company anymore, they still count as participants for this count. So it's a lot more than, you might have a company that has 80 employees, only 20 are participating, but you have 50 people that have left the company over the past years that still have balances in the plan. That's going to push you over 130. I think my math is right.
Yes.
And an audit would be required, even though you only have 20 people participating in the plan currently. And that's, it's unfortunate, but that's the way the rules are written.
And as of the beginning of plan year. So this
Absolutely,
is why we kind of do these audits now, because it's important to remember that right now we're looking at 1/1/14
right.
to determine if you need an audit in 2015 for the 2014 plan year.
Exactly.
So yeah.
And we'll talk about when these things get done in the next slide here. So they're required to be completed within 7 months after the plan year ends. So here's your example. We've got our 2013 plan year. It should be 2014, but let's just pretend we went back in time a year. And we're looking at 2013. So we got 1/1/2013 through 12/31/13. That's your plan year end. You had 100 participants over 120 participants at 1/1/13. Then you need to get your audit done within the next 7 months. So that would be by 7/31 of this year, or by 7/31 of this year. But you also get an extension, and that is an automatic extension to 10/15. So 10/15 is the functional deadline for these audits to get done. And that's a long time from the end of the year to that deadline. Most of these audits get done during the summer. I'd say between June and August, the end of August, end of September is our busiest time when it comes to benefit plan audits. So getting started around March, April is pretty rare. It's actually pretty difficult to get done.
And then if you have like defined benefit plan for the finance folks on the call, you might want to hold out, right, till September 15 or so, because you're trying to make some corporate deadline deduction rule or something for your last contribution.
Absolutely.
Yeah.
Okay. So when it comes to financial reporting, you've always filed a 5500 for a 401k plan, hopefully. If you haven't been filing a 5500 for your 401k plan, you should probably stop and give us a call, because you probably should have been. 5,500 for a small plan that's under 100 participants is very simple. It is a Form 5500 short form, or SF, and it is 2 pages long. And that's generally what people file now if they have a small plan, a small 401k plan. When you grow up to be a large plan, the filing gets much longer and much more complicated, and this is kind of where we come in, and also your providers. They're going to be able to help you out and put together this filing. So you've got your basic Form 5500, Schedule A if you have any insurance contracts, Schedule C, which is super complicated, a Schedule D for certain investments. You're definitely going to have a Schedule H. That's what the auditors are going to care about. It's the financial information. A pretty useless Schedule R, but it's still required. And then up to 20 pages of audited financial statements, which is that you can kind of see the volume of reporting that has shifted. I like this slide because it kind of shows that your responsibility has just it's increased by 100 times. So it's kind of shock if you're kind of used to just the set it and forget it kind of reporting. Now we've got a lot more to worry about. So what can you expect from your audit? Now that you know you have to have an audit, you've got all this large reporting requirement. I would say whenever I'm explaining what I do for a living, I kind of say, I wear 2 hats. I am a CPA. My background is in accounting. I know as much as I need to know about things like revenue recognitions and equity accounting and all that stuff, because I do work in my other life. When it comes to benefit plans, though, the financial reporting still there. We still have to put on that hat and do CPA stuff when it comes to auditing. But there's also another half to this, which is the compliance, and that's kind of the more the HR side, more the IRS compliance, the DOL compliance, the things that you don't think about when you think about a CPA. When you've got those 2 hats on, it does you kind of have to split your time between the 2 of them. And I would say the audit kind of splits about 75% compliance, 25% financial reporting, just so that you kind of get a flavor for what we're going to be spending our time on.
And this is why practitioners work very closely with the Department of Labor and the IRS and everything the CPA has, the Quality Center, the Experts Panel. We really try to work with the regulatory folks to educate them actually what an audit is, and then to kind of find that fine balance of the things we do for them. Because a lot of times, finance folks will be like, well, didn't you audit 100% of this, or why did you ask for enrollment forms?
Exactly.
So we usually have to bridge that, that world of, well, there's compliance we're doing, and then yes, if we did a financial audit, half these accounts might be, immaterial to audit, or we would have been looking at something different.
Absolutely, yeah. So we do have to bridge the gap between CPAs and HR and compliance and financial reporting. There's a lot of different hats that we're wearing while we're doing these audits. How can you prepare for an audit before we even get there? Any auditor, whether you select Moss Adams or anybody else in the industry, they're going to be asking you for these types of documentation or this kind of consideration from the management of the plan. So I kind of break it down into 5 different categories. Document gathering and organization, that's number 1. It's kind of the most fundamental. We're going to talk a little bit about fiduciary responsibility, then operational compliance, internal controls, and financial reporting. So the first thing, very fundamental, is document gathering. Especially in first-time audits, I can't tell you how many times I've gone out to clients and asked for very basic documents pertaining to the plan, like plan documents, determination letters, amendments, and there's a misconception as to what these things are, or what is a complete plan document if you had a prototype plan, things like that. Or where are these things? I've never even seen them, and we don't have executed copies of these plan documents on file. I think the provider might have them. These kinds of things are just fundamental to have a good hold on where these documents are, what they are, and how to and that we're keeping track of them, that they're all executed and they're up to date. So these are the 4 most important ones that are going to exist for every single plan. Is there's going to be a plan document, there's going to be a determination letter, unless, of course, you're a 403B plan, which there is no determination letter program, so you don't have to worry about that one. There's all kinds of other stuff you need to worry about, but not a determination letter. Executed amendments for your plan document, and then summary plan descriptions and summary material modifications. This is what the participants get to kind of describe the plan to them. The plan document being the legal document that sets forth the terms of the plan, summary plan description being the plain English version that a participant would get.
Yeah, and just to preface, these documents are really a roadmap, right, of how your plan works. I mean, so many times we get questions of, can I do this? And it's like, what does your plan document say? Did you want it to say that, or do you want it amended? So for, again, finance folks, this is, again, very important to understand that these documents rule your benefit plan world, and it could be counterintuitive or different than what you think should be occurring.
Absolutely. And we'll get to that when we get to compliance, a specific example of exactly that situation that happens all the time. If you have a committee, and we'll get to that when we talk about fiduciary responsibility, executed 401k administrative committee minutes should be kept organized and on file. Also, any board minutes pertaining to the plan. If you have an administrative committee that oversees the plan, there should be probably a board resolution that authorized that committee to do so in the first place. So that, at the very least, generally the board doesn't talk a lot about the 401k plan other than that, to authorize the committee to oversee it.
And absent that, the board is liable, which few boards know that, which we'll talk more about. Yeah. Few boards realize that, if you will.
Other than those, I've kind of recapped that, those 6 on this slide here. We've got a couple others here that are a little bit less, I don't want to say important, but definitely not as critical to have on file and very at your fingertips. Trust and record-keeping agreements with the custodian and record-keeper. You better believe that if you have a trust agreement or record-keeping agreement, even if you don't have it on file, your providers definitely do. But this is going to set forth the terms of what the record-keeper and trustee are going to be doing for you. They're important to have on file, but as it goes for the audit, they're less critical than, say, something like a plan document. Copies of past Form 5500s, copies of past audited financial statements if you have any, copy of fidelity bond insurance, which is a legal requirement to have the plan covered against crime, against theft against the plan, employee dishonesty. That is a legal requirement. You have to have that coverage. If you don't, give me a call. We'll figure out what kind of coverage you do have, and we'll hook you up with somebody that can help you get that kind of coverage. And then any other agreements, any correspondence you have with the IRS, the DOL, should be kept on file. Any corrections that you've done, definitely keep a file, historical file of all the things that you've done for the plan or set up for the plan.
And again, for everyone on the call, I mean, some of you may be going through your first audit at some point, and some of you may have been going through the audit even with us. So this is always a great cheat sheet, though, right? To just
Absolutely.
Have on file, and when you're doing like even acquisitions, it's good to go, oh, we're going to acquire a company, they have a plan, let me pull out my cheat sheet of documents I need to have on file.
Absolutely. I mean, if you pull these things together and put them in a binder also, or in the paperless world, a folder, on your network or something like that, it's all there.
Yeah.
No matter who your auditor is, I guarantee they're going to be asking for all of this stuff on this page.
Yeah.
So it's just easy enough to wrap it all up and transfer it in secure manner, of course.
Make this up to date.
Yeah. So,
absolutely.
But it's going to be easy for you if you gather it in advance. So here's a poll question about those documents. Do you have all these documents ready right now? And let's kind of add a little bit to that in an organized way that you can access very easily. No, and I'm not sure what even some of these things are. Maybe, but I think I know where they find them. And then yes, we are totally prepared, or you don't know, or not applicable because this isn't your job.
And while we're waiting for folks to respond, I'll just remind everyone, because I know often we lose sound, so feel free to push F5 on your console. You can always refresh. Or for the folks on Macs, you can do Command plus R. So, or you can just relaunch altogether. But, and of course, Courtney is standing by for any questions on technical stuff. Okay,
so we're going to go ahead and advance the slide. Looks like most people are at least half prepared.
Cool.
Some people are very prepared. They are, so some don't know. But it's good to not see no from a lot of people, it's always good. I think maybe is probably the most common answer. I know where the plan document is, or I know where the SPD is, and I might know where my trust agreements are. I'm not sure. So that's kind of what I get a lot out of a lot of first-time audits when we're going out there also. Okay, so moving on. We're going to move on from documents to fiduciary responsibility. So fiduciary responsibility is a very kind of sticky concept in general. I've been to a lot of presentations where where a presenter will ask the question, who in this room is fiduciary? And nobody will raise their hand. And then we explain what a fiduciary is, and everybody raises their hand to that same question.
And Mike, can you repeat what we talked about the board level just before we go further? We have a question.
Absolutely,
on that. Yeah.
So what we talked about at the board level was, by default, a board of directors of a company is going to have fiduciary responsibility for a plan. That means reporting responsibility. That means if anything goes wrong, they will be on the hook.
Okay.
And generally what boards will do is authorize an administrative committee to take that responsibility, or some other plan administrator, somebody else. In general, they have to do that formally. It'd be a minutes or some sort of resolution. And this is done generally very early in a plan's life. Absent that sort of resolution or authorization, they're still on the hook. So generally what we'd like to see is them authorize, as the time the 401k plan is being implemented at the very first, day one of the 401k plan, you'd want to see a board saying, yes, we're signing this up, we're starting the 401k, and we're authorizing somebody else to be the fiduciaries of this plan.
Exactly. Yeah. And again, absent that, that's what I think people realize the least is absent that formal authorization, the board is on the hook. So
absolutely.
Other groups and folks could be doing fiduciary stuff, right? But legally, that's who the deal will look at.
Think of it as the company, as an entity separate from the company completely, which is what it is. If you start a company, the board is on the hook fiduciarily for that company. If you start a plan, it's the same deal. But most, I would say 99% of the time, 100% of the time, the board does not want that. So they authorize somebody else or some other body to be that fiduciary. So what is a fiduciary? I've been throwing out that word a lot in the last 5 minutes. This is the textbook definition. This is, I believe, right out of DOL regs, or at least it might be massaged a little bit. But they exercise any discretionary authority or control over plan management. That means if you have the authority to sign a plan document or an amendment, then you are a fiduciary of the plan. Any authority or control over plan assets. That means that if you have the authority to choose the lineup in your 401k plan or change the lineup, you are a fiduciary. Renders or has any authority or responsibility to render investment advice for a fee. If you are getting investment advice from an outside investment advisor for a fee, they are a fiduciary. And have any discretionary authority or responsibility over plan administration. This is the sticky one, where it can kind of apply to almost anybody who touches the 401k plan. If you have control over things like internal controls or just policies about how we process payroll for the 401k plan, if you're in charge of anything that has to do with that kind of thing, you are a fiduciary of the plan as well. So it's a very broad definition of what a fiduciary is of a plan. And it's a little scary for some people, especially if you're a payroll manager. That
paying people.
Exactly. You're just paying people, but you're in charge of things like figuring out what eligible compensation is, figuring out how the transfers go to the controls over the transfers of pay to the 401k administrator, things like that. You can be considered a fiduciary. So that is a little bit scary for some people, but that I'm just here to deliver the message here.
Yeah. When in doubt, I always tell clients, just assume you are, and please act in the highest.
Act as if.
As if, in the highest, moral manner that you can possibly do it.
So generally, you'll form a committee, and I want to get a polling question out. Another one, number 3. What most describes your 401k committee? You've formed a committee and have met a couple times. We've formed a committee, met a couple times, and sometimes take minutes. We formed a committee, meet regularly, and always take and retain minutes. Or we're going to do that tomorrow because you haven't formed one yet, but you realize it's a pretty good idea to do so. So we'll give it a couple minutes.
Time on the board agenda, the next board agenda.
Exactly. Okay, I think I'll move on. We're all kind of all over the board here. Which, you know what? I'll say most of you all have formed a committee, meet regularly, and take and retain minutes. That is absolutely the best answer here. Obviously, I think the most common answer I see, especially when it comes to new plans, is either they don't have one, or they've formed one and they don't take minutes, or they take minutes sometimes, and that kind of thing. Always take minutes of any action or meeting that the committee has. If you don't take minutes, it's like you never met at all. You can't demonstrate that you, in a court of law, there's no proof that that meeting actually happened.
Right. I think you have that on the next slide. That is super important, because one thing the Department of Labor, I think, requires is, don't kind of tease them and put something in place and then either have it not be effective. I think you'll get in more trouble that way. So if you have a committee, make it effective, do meet, and like Ryan's saying, document your actions. There's a lot of fiduciary things that I think our clients do on a daily basis, but they forget to document them. Mm-hmm. Just calling us on questions, bouncing things off, one another, meeting with providers. There's so much that happens that I think you don't give yourself enough credit, and then later, God forbid something does happen, the DL will say, well, you never, this plan was on autopilot. Mm-hmm. So, and it's, the burden of proof lies on you as a fiduciary. And
this slide just has some bullets about what a fiduciary should do. We talked about form an administrative committee. Again, not a requirement. You don't have to form an administrative committee, but in industry, it is a best practice. It is probably the number one best practice when it comes to this industry. Hold regular meetings, retain minutes of the meetings. We've talked about that. Develop and follow an investment policy. An investment policy is like it's a roadmap of the type of investments you can select that your participants can invest in a 401k plan. It's an outline document that can help you form the kind of investments that you want to have in your plan and set benchmarks for when you might switch one out.
Yeah, I'm just going to backtrack a little bit.
Sure.
We've got a couple of questions. So on the regular meetings, we get this all the time.
Yeah.
What's the perfect number of meetings in the year?
I would generally say no less than annually. Yeah. Definitely no less than annually. That is the bare minimum. I would recommend quarterly is probably best. Some people think that's too often, so semi-annually is probably fine. I will say one thing about quarterly, and I have some companies that have two committees where they've got an investment committee and an administrative committee, and they both do different things, and they each meet monthly. So we've got 24 meetings a year, which is really excessive for a small company. Right. But the whole thing about meeting quarterly is that if you meet semi-annually or annually, you're only going to focus on one or two things, and you might miss some stuff. If you're doing it quarterly, you can kind of jump around a little bit, where you focus on investments maybe one quarter, you focus on the audit maybe in the next quarter, or just financial reporting in general, and then you can focus on compliance in another quarter, and then investments again. You can kind of spread it out. You don't have to do it all in one hit. So,
and that's an excellent point on the components. I think folks forget that investments are such a huge part of these plans, but then there's the operational side. So, like annually, like now, beginning of the year, everyone's doing their compliance testing.
Correct.
Well, that's a good time to meet, and then maybe you might have open enrollment later in the year, so you might want to hold a meeting there where people are coming on, so you're reviewing investment lineups. So that's a good point to remember, that you can the committee can oversee both investments and operations, or you can have separate committees. However, both of those areas have to be looked at.
Absolutely.
I guess that's the key.
Right.
Another question popped up on, is this only for companies with employees over 120?
No.
And that's not you have a plan with 4 people, this is great fiduciary governance. Because remember, if we as independent auditors are not looking at your plan because it's too small, the DOL and IRS can look at it at any point in time.
Right.
And we do a lot of consulting in that area where folks are going through an audit because their plan just got, lucky and got picked, but it doesn't have a financial audit.
Absolutely.
So fiduciary governance, it's never too late to start or too early. So please don't think like, if you're a large plan being audited, you should have a committee.
Right.
Yeah.
And I think a lot of the general feeling in the industry, especially for the first time you're going through this audit, is that it's another requirement. It's another cost.
Right.
It's something that we have to do because the government says we have to. That is true, but you can kind of think of your financial auditor as as painful as it might be to get through that first audit, we are your first line of defense. There is nothing we can do legally. If your plan is completely screwed up, you've messed up every single thing that is under the sun, we're there to help you. We're going to help you correct it. We're going to set you up with the right people to do so. We're going to give you suggestions on what you can do. We will not fine you. We can't report you. We're not going to do any of that stuff. We are there to help. And that I think getting the most out of that, especially in a first-year audit, is super important.
Huge.
Yeah, exactly.
And that's why sometimes when you're dancing around a certain number of employees, people go to auditors, right?
Yeah.
Because they're kind of like, hey, we're going to get to that point. What should we know?
Right.
Investment policies, not required, correct?
Correct, not required. Also, but in the industry, if you ask any attorney, best practice. Absolutely best practice.
Exactly. So that's another thing we want you to take away from an investment policy. It's kind of a roadmap.
Yes.
For what you intend to do or not. Do you want to diversify in your plan? You don't. So it's just kind of a very good best practices.
One thing that is a requirement is review and administrative fees being charged for the plans for reasonableness. That doesn't just mean your auditor fee. That means all the fees, all the hidden fees, the ones that you can't really see by looking at an invoice. Those are the ones that are should be the most scrutinized and the most it is a legal requirement that you do so. If you are not reviewing fees for reasonableness, you are breaching your fiduciary responsibility by law.
Right, and this was the DOL a few years ago.
Absolutely,
right?
yeah.
They came up with all these fee disclosures because they knew there was a lot of hidden fees that participants didn't know, because what investment folks do is they net them against earnings. So I don't know how much I'm losing because my net investment gain in my account is 4%, but it could have been 10, and I don't know because I'm paying excessive fees.
Correct.
So the DOL said, wait a minute, we want transparency. So this is, like Ryan mentioned, one of your key required fiduciary duties, if you will. Understand your plan expenses.
And that goes to the next point, actually. So what do I know about hidden fees? I am a controller of a tech startup company that's growing faster than we can even handle. What do I even do? How could I even possibly understand this stuff without going to school again? The answer is, consider employing the services of an outside investment advisor. This is what they do for a living. This is their job, and what they will do is it is for a fee, but you hire them. They come in. They will make sure you're meeting quarterly. They'll lead the discussions on investment reviews. They will review the fees. They'll benchmark your plan. They'll go shopping for another provider if the provider you have is no good or charging too much. 401k providers are like cable companies. You'd never get the best deal unless you go out and ask for it, or you change provider sometimes. And that's and that's kind of the way it works with these 401k providers. The investment advisors know what the deals are. They know how to ask for them. They know where to ask for different things and how to work the system.
And that's not to say you'll make a change. Again,
Right.
This is not to stir the pot or have to change your provider every year. It's just to have sound information.
Absolutely.
To let the DOL know that, hey, I did my fiduciary governance, and maybe this person, this other provider was given a break a little bit on fees, but they didn't have this that my, participants need, and I analyzed it all, overall benefit, versus cost analysis, and I'm good where I am, but at least you did your due diligence.
Absolutely.
Yeah.
It's not a legal requirement to pay the lowest fees.
No.
It is a legal requirement to assess the reasonableness of your fees for the service that you're getting and the quality of investments that you're getting, and assess that they're reasonable. It's not about the conclusion. It's about the process for everything fiduciary. And that's more thing. You might miss the mark on an investment. It might lose tons of money and you selected it. But as long as the process was sound in selecting that investment, that you went through a thoughtful process, you're fine. You're going to be okay.
Exactly. Yeah. Very good point. Yeah, it's about the process for the DOL.
Okay, so we're going to move on from fiduciary. Unless some questions pop up, we might circle back around. So we're going to shift gears and talk about operational compliance, which kind of bleeds into the fiduciary responsibility. When we think about fiduciary responsibility, we talk a lot about investments. Operational compliance is kind of the thing that we kind of assume that we don't have to worry about operational compliance because we hired Fidelity to do that, or Vanguard, or whoever.
I love that. That's my favorite.
Exactly. And I don't know about operational compliance, but that's why we hired whoever, so they're going to handle it. There are a lot of things when it comes to internal controls and operational compliance that the company is still on the hook for. And I'm going to highlight 3 of the most common errors in operational compliance that we see in all audits, not just first-year audits. The first being plan eligibility. Who's eligible to participate in the plan and when? What kind of employees? What classes of employees? Which ones are not allowed to participate? The most common error for this is we assume as HR folks or just the company in general that our health benefits eligibility is exactly the same as our 401k benefits eligibility, and that may be true, but while the health benefits is more of a policy, the 401k benefits is written in stone in a plan document, and you have to pay attention to that plan document. If they're not the same as your health plan, whatever the plan document says is the truth. That is what you have to do. Right. If you're doing something else, you're doing it wrong. Right. So what's our best practice? Make sure you understand what the plan document says with regards to eligibility, who and when can be allowed to participate. If we make an error on this, it can be costly. If we're leaving out, I always use interns as because we see this all the time. Interns don't get health benefits. But there's nothing in the plan document of the 401k plan that says anything about interns. We don't even mention them. It just says all employees.
So they're eligible.
So they are eligible. They were an employee. They were eligible. But we've never even allowed them the opportunity to participate in the plan. Right. And that's a no-no. So now if the correction for that is, well, now I have to treat them as if they would, not even they had the opportunity to, that they would have participated. And and it's not like, oh, okay, well, I'm going to take money out of their pay and adjust their pay or anything like that. No, it's the company funds as if they were participating the whole time.
And any matching contributions.
And any earnings on those matchings.
Yeah, and we work with a lot of universities at Moss Adams.
Yeah.
We see a lot of complex eligibility rules.
Yes.
Classes of employees, adjunct professors, full play. I mean, we have some that are like pages and pages. So, if you can't, my recommendation is keep it simple.
Absolutely.
Keep it simple, but if you're just not able to do that because of your organization, then monitor carefully.
Yes.
Do spot checks before it's too late, because at some point it might just be, a little too late. Now, a question has come up, if you offer health insurance to interns, do you have to offer 401k?
Absolutely not.
Absolutely not. That's what we're trying to say is these are two different legal entities. The 401k plan is a legal entity in it itself. You can exclude or include based on ERISA and other legalities, so it has nothing to do with your health side, health and welfare side. Okay,
correct.
Excellent.
Yeah, that's a good question.
Great question.
Be especially careful of auto-enroll. That's the one thing I will add on this also. Auto-enroll is an awesome idea. I love auto-enroll when it comes to helping employees actually save for retirement. The studies have been done. The psychology works. People auto-enroll. However, it's super easy to screw up.
Yeah, it is.
Because it's automatic. So it's kind of, you have an attitude of set it and forget it. Yeah. And if we're not monitoring who actually was auto-enrolled or who might have not been auto-enrolled, it's very easy to miss. So just keep an eye on that one. All right. Definition of compensation. This one is it's very complicated. This one seems like, whenever I explain it, I feel silly because it seems like it's so complicated that why would anybody care about this? The idea of definition of compensation, and the IRS cares very much about it, and that's why we drive it home here. Definition of compensation, this is the types of pay codes that deferrals to the 401k plan get calculated on. So let's say we've got regular pay, we've got bonus, we've got commission, just to keep it simple. Your plan document may say that only base pay is eligible for 401k deferral. So things like bonus and commission, if people are earning those and they're deferring, say, 10% of their total comp to the plan, only that 10% would only get calculated on the base pay. You would have to exclude the other two codes. Now, generally we see the reverse. Generally, we see all codes are included, all compensation codes, or all W-2 compensation is one. But then you get into the question of what is W-2 compensation? Do we even really know? And we've got hundreds of pay codes in our payroll system, and we need to go through every single one and scrutinize whether that falls under the definition of W-2 comp or not. And I use W-2 compensation as a example but it might not be that. It might be something else. So what's the best practice? Go through your plan document, get an understanding of what the compensation definition actually is. If you don't understand it, ask a tax professional. We can help you out with that. We have that capability.
You see grid.
Yeah, absolutely.
You can email one of us that we share with our clients if they don't have one that payroll spits out, but it literally has eligible, ineligible, and
Yes.
of course employee deferral match, whatever other types of deferrals you have.
Right.
Another thing we see are payroll people, right? They move around.
Yes.
And this is a classic where they come to a company and they just withhold on whatever the heck they want.
Mm-hmm.
And when you go, what are you withholding on? Does that match the document? And they go, I don't know. This is how I did it in my last company. This
Right.
is how I've done it all my life. So it is an area of risk that does have to be maintained.
Yes.
A bit. Yeah.
The biggest takeaway is that this is it's a very complicated issue because we're talking about a lot of different tax codes with different types of pay, and my advice to most, especially small companies, is keep it simple. If you have 10 pay codes and they're all basically W-2 compensation, great. They're all included. Let's just keep it simple.
Yeah.
If you have some weird funky pay codes and you want to keep them excluded, great.
Yeah.
Let's keep them excluded.
Or if you have bonuses that are called 10 different things, make sure that those definitions match something.
Absolutely.
And just call it a day. Again, like Ryan's saying, just call them bonus. But if you have like 5 different bonus types and 2 are excluded and 3 aren't, you got to have a basis for that.
Exactly.
Yeah.
Right.
Okay.
So this is also the third one. Compliance issue is timely positive participant deferrals. The concept being we're taking money out of people's paychecks, and we are the custodian of that. The company is the custodian of that money for at least a short period of time, and hopefully it's a short period of time. As that period of time gets longer, we are essentially borrowing money from our employees without asking. And that's the way the DOL sees it, very, very much so. So if I'm the Department of Labor and I'm coming into a company and I'm seeing that it's taking you all, the company, 15, 30 days to transfer participant money from the corporate accounts to participant accounts in the plan, that is a major problem. Now, I threw out some numbers there. Those might seem excessive. What is the standard? How fast should this be being done?
And that's individual.
It's absolutely,
This area is one that they're all going to look at the company
Right.
overall. They're going to look at your payroll deductions. They're going to go, how can you feed the IRS and the franchise tax board within a few days, but you can't feed your participants their deferrals
Correct.
within a few days. So they are going to look at your overall controls.
Yes.
And here you have to speak up, if you will, because this is an area we find that companies are disjointed, right?
Yeah.
They don't see maybe a risk that this money withheld has to get somewhere quickly. It's like
Right.
a hot potato. They wait, we had a reconciliation issue, or we had this, or, my provider doesn't do this. Just get it out of the company assets, get it to your provider, and then that's okay.
Right.
Then you can make adjustments, you can do a lot of things, but don't think that that's okay, because the deal will always look at you as a fiduciary and go, that's not okay.
Right.
Yeah.
Now, there's no standard. There's a rule that says you are absolutely late and need to correct as such. So the correction is if you conclude that you're late, you need to make up lost earnings and pay us an excise tax. So how do you know if you're late or not? Well, if it's after the 15th business day of the close of the month after the following pay date, that's the last bullet point, which is a long time. It can be up to 45 days. It's always considered late. There's no exceptions.
Yeah,
you can't get out of it, whatever. But that is not a safe harbor.
Yeah.
Generally, you're going to want to look at trends, and you're going to want to look at kind of your best trend. If you're demonstrating that 3 days is your average, and don't do mean, median, or anything like that. If you just look at them and say at your transfer days and say most of those are 3 days, then your best policy is probably 3 days.
Yeah, and that's an excellent comment, because we got a question to that. Setting precedence is very important.
Yes.
So if you have set a precedence, unfortunately, as an overnight or the next day, that is your best guess.
Exactly.
So the DOL will look at that and say, what's the reason for changing? And just saving on cost is not a good reason. So that's an excellent point to a question that came up.
Yeah.
So you are going to set precedence, and the DOL will look at that. They can impose, right?
Absolutely.
We've seen them come in, and we've worked with organizations. They have 10 pay cycles or 10 pay locations reporting all at once, and they've mandated that all locations remit within 3 or 4 days. So we've seen really aggressive timelines set by the DOL.
Yes, I've seen that.
Yeah.
Especially, we'll go out. I've actually gone out to a client, first year audit, and said, you have risk here, and they say, well, it's my call, right? I get to decide whether they're late or not. I'm like, yes, but they are.
Yeah.
You should correct as such. And they didn't.
Yeah.
They got DOL audited. Guess what they said? And they said they were late, and they did have to correct.
And the participants look for it in their account.
Yes.
Right?
Yeah. Okay.
Now,
So we're going to move on from timely participants. We're going to talk a little bit about internal controls. This kind of goes hand in hand with compliance because we talked a little bit about your policies, right? Yeah. We talked about policies. We talked about things to think about. We talked about best practices. Those are all part of internal controls. The same concept for internal controls is the same thing as compliance. I've hired Fidelity or whoever to do all this stuff, so I don't need to worry about internal controls. It's not a big deal for us. Especially if you're a smaller company, you're exactly 121 participants, internal controls may not even be a really hot button issue on the corporate side, on the financial side. So I understand that internal controls mean different things to different people, and you're going to have to scale these to the size of your company. So one thing you can do to kind of get an idea of what you should be doing for internal controls on the 4-year plan is very simple. Most TPAs, most record keepers, have an SSAE 16, or they're also known by SOC 1s. They used to be called SAS 70s, that detail exactly what they do for controls on the record keeper side. In addition to that, they have a section called the user control section that documents exactly what they think the companies should be doing so that they can rely on the controls at the record keeper. The idea being garbage in, garbage out. If there are bad controls over things like participant data or eligibility or those kinds of things at the company side, and you're providing bad information to the record keeper, they're going to just process that bad information and turn it into worse information. And that's the concept. So any data exchanges, and we'll go through some of the highlights of what happens there. Actually, that is out of order, that financial reporting slide.
Oh.
So that is okay. I skipped it. Mm-hmm. So internal controls. I've looked through a lot of SOC 1 reports over the years, and we've seen trends of these 3 major controls, user controls, in every single SOC 1 in one way, shape, or form. A lot of them have more than this. Some have less. Some have less than others, but these 3 are almost always present. So I can very safely say, have these controls in your company for a 401k plan. Review outgoing participant data provided to the plan record keeper. That data, any data you're giving to the TPA should be solid, should be checked for accuracy, should be made sure that it is right, because they're going to take that data and they are going to process it and make more data with it. So this is the starting point. This is what they're going to use to start their plan administration. On the flip side, they're going to be providing you all kinds of data, things like changes in deferral rates, or changes in, there might be other changes that people are making on the Fidelity side, on the TPA side, that are coming into your payroll or HR systems, and those need to be checked for accuracy. If that upload goes off badly, or it's a manual update and nobody's checking over somebody's shoulder, I'm not saying anybody's going to commit fraud. They could, but more importantly, they might just make an error. They could do a key error or something like that. If nobody's checking it, there's no control, those key errors can be turned into big problems. The last thing being review of plan reporting. You're going to be getting monthly reports, quarterly reports, distribution reports, contribution reports, all kinds of nice reports from your TPA. And those, a lot of the times, just go into the circular filing bin under your desk, and they get just thrown away. If you look at any SOC 1 report, it's going to say, we're going to give you reporting, you need to review it, and you need to point out any errors, and we need to resolve those. They're giving you these reports for a reason. Make sure you're reviewing them and that they appear reasonable and they seem right. Okay. So that is it for internal controls. I don't like to make a big deal out of it. People see auditors come and we say internal controls, and people start freaking out and thinking SOX, 404, all this stuff. Yeah. It's not that big a deal. But if you do these three things and you have good controls over these three things, you're going to answer about 90% of a 401k plan auditor's questions.
That's positive, yeah.
Yeah.
Okay.
All right, so we're going to move on to the last part, which is financial reporting. And I'm not going to go back to that slide 26 or I'm sorry.
I think you want to go to best practices maybe because we only have a few minutes left.
Yeah.
Because we have one more polling question we'd like to get to.
Yeah, this is it right here. There's when it comes to the accounting for benefit plans, there are two major sticky areas. And one is fair value accounting and disclosures. And we spend a lot of time doing fair value disclosures for different types of investments that you'll see in 401k plans. The best practice is if you have anything that's not a mutual fund in your plan or a money market fund, it's more and more complicated for the fair value accounting and disclosures for your auditor and for you to take responsibility for. So if you have anything that's like an insurance company product or a common collective trust or pooled separate accounts or anything like that, these are not mutual funds. They look a lot like mutual funds, but they're just not mutual funds. And the accounting is more and more complicated the further away you get from a mutual fund type investment. So what's your best practice? I would say consult your auditor about these kinds of things if you're not sure about how the accounting goes for them. We've spent a lot of time since 2008 when the standard came out understanding these investments, the accounting for them, the different disclosures that go along with them. If not, obviously, if you're a controller or a CFO, you probably have some exposure to the standard, so you're going to be a little bit more educated on this. But again, any questions, anything, we can walk you through the minefields and kind of point you in the right direction on fair value accounting. The last one that's a little bit weird is stable value funds or guaranteed investment contracts. Stable value funds look a lot like a money market fund. Well, both of these do. They transact at $1, they don't lose value, and they pay a steady interest rate. So it sounds like money market. But they're structured so the returns are guaranteed by insurance wrappers. So there's an insurance company that's going to guarantee that return.
Where they're a little complex.
And the whole thing is that the accounting for this, we spend a lot of time trying to figure out these contracts and make sure that we get it right when we do the financial statements.
Right.
If you have one of these, just make sure that you're aware that this is not a money market fund and that there is going to be more work when it comes to your audit and the reporting when it comes to these types of investments.
But this goes back to fiduciary and just understanding your investment so that there could be a little more complex than you think.
It's kind of know what you don't know.
Exactly.
Right.
Exactly. Do you want to get to the polling thing?
Yes, I do.
Yeah, because we have the best practices. You guys can read that on the slide.
Absolutely.
So let's go do the last polling, and then we'll turn it over to Courtney.
Absolutely. So out of the 5 preparation areas, which do you think your company is prepared for the most? Obviously, if you're prepped in all areas, you can go and click that one. We should probably reword this question and maybe like combinations or something. But
I know, right? You can only be good at one thing.
Yeah, exactly. All right.
We've answered some questions to date. I have. So again, if anything we haven't answered, please feel free to contact.
Absolutely.
Ryan.
We'll have our email address at the last slide here.
I'm going to turn it over to Courtney soon after we get the results here, and she'll go over some more CPE stuff. And I think she's been answering things like what we're doing with the slide deck. Oh,
looks like 50% of people are prepared in all areas, so that's good.
Yeah.
You got hopefully this webinar made you feel better about yourselves.
Yeah, we like doing that, and then you know what you shouldn't feel good about.
Yeah.
Excellent.
Okay, so I don't think we have any unanswered questions at this point, so I'm going to put this slide up with my shining face on it. Okay. And if any questions, just email me anytime or give me a call.
We'll turn it over to Courtney. Thank you.
Great, thank you. Thanks to Ryan and Bertha today, and of course to our audience for joining us. I did have a few questions on CPE and the presentation slide deck. There's a folder at the bottom of your screen. You should be able to download the slide deck from there. If not, an email will be going out with a link to a survey and also a link to that slide deck. So you should receive an email shortly after the end of the presentation. In addition, if you were having issues downloading your CPE or the CPE was dated, it has been updated, so you can go ahead and download that updated version. If you don't see the current date on your CPE, close out of the system and relog back in, and you should be able to download it from there. Again, if you have any questions, please feel free to contact me or any of our presenters. And again, thank you for joining us today. Have a wonderful afternoon.